Hello everyone and welcome. Let's jump right in. Today we are completely mastering Section 22 of the Income Tax Act 2025. If you're a CA student, a tax professional, or just an aspirant looking to sharpen those technical taxation skills, you're in exactly the right place. We're going to unpack the precise statutory deductions allowable when computing income from house property. Okay, let's dive straight into the statutory language so you can confidently tackle your exams and practical client files.
Here's our quick roadmap for today. We'll cover the house property tax flow, Section 22(1) basic deductions, limits for specified properties, certificates and double deductions, aggregate limits and overseas interest, and finally wrap it up with a practical master computation.
All right, starting with Part 1, the house property tax flow and exactly where Section 22 fits in. You see, the absolutely crucial point here is that Section 22 acts as the sole gatekeeper for your expenses. When computing house property income, you always start by determining the annual value under Section 21. But that annual value is literally just your starting point. You can't just randomly deduct municipal taxes, repair bills, or society maintenance charges wherever you feel like it. The Income Tax Act is incredibly rigid here. Section 22 authorizes the exact, strictly defined subtractions you can actually claim against that annual value to arrive at your final taxable income.
And this brings us to the first massive relief provided by the Act. Under Section 22(1)(a), the assessee gets a flat 30% standard deduction. This 30% is calculated straight on the annual value determined under Section 21. What's absolutely brilliant about this in practice is that it's a flat rate. Whether you spent a fortune on painting and repairs or you spent absolutely zero during the tax year, you get this 30% deduction unconditionally. It completely replaces the need to hoard and track actual repair receipts. So, if your annual value is 10 lakh rupees, you instantly deduct 3 lakhs. It's simple, clean, and totally unconditional. Moving on to Part 2, Section 22, Subsection 1, which covers the basic deductions.
Now, Section 22(1)(b) is super clear. If you take a loan, what the Act calls borrowed capital, for specific purposes, the interest payable on that capital is deductible. But listen closely to the specific words used in the statute. The property must be acquired, constructed, repaired, renewed, or reconstructed with this borrowed capital. If you take a mortgage on your house to fund, say, your child's education or a big family wedding, the interest on that loan is definitely not deductible here. The borrowed capital has to directly relate to the property itself. Also, notice the word payable. The deduction is purely on an accrual basis. You can claim the interest for the year even if you haven't actually paid a single rupee to the bank yet.
Furthermore, the statute completely recognizes that homes take time to build. So, under Section 22(1)(c), we address what happens if you borrow capital during a period prior to the tax year in which the property is finally acquired or constructed. This pre-construction interest doesn't just vanish into thin air. You aggregate the total interest payable for that entire prior period. Then, you're allowed to deduct it in 5 equal installments. The first installment is claimed in the exact tax year the construction or acquisition is actually completed, and the remaining 4, they're claimed in the 4 immediately succeeding tax years. It's a fantastic mechanism, ensuring the assessee gets the full benefit of their interest burden, just spread over time. If your total pre-construction interest adds up to 5 lakh rupees, you don't claim it all at once. You claim exactly 1 lakh rupees in the year of completion and 1 lakh in each of the next 4 years.
Let's move to Part 3, Limits for Specified Properties, which brings in some major restrictions under Section 22(2). Section 22(2) creates a really stark contrast. If your property falls under Section 21(6), which is generally your self-occupied property, your aggregate interest deduction under subsections 1b and 1c isn't unlimited. Instead, you face a massive cliff. The deduction is capped at a maximum of 2 lakh rupees, provided you meet highly specific statutory conditions. But if you fail to meet those conditions, the limit drastically plummets to a mere 30,000 rupees. Let's look really closely at what those conditions are, because a sudden drop from 2 lakhs to 30,000 will severely impact your whole tax computation. To unlock that higher 2 lakh rupee limit, Section 22(2)(a) outlines some incredibly strict prerequisites. First up, the property must be specifically acquired or constructed with the borrowed capital. Notice what's missing? Repairs and renewals don't qualify for the higher limit. Second, and this is a classic exam trap, the acquisition or construction must be completed within 5 years from the end of the tax year in which the capital was borrowed. Let's say you borrow capital in August 2025, while your 5-year clock only starts ticking from March 31st, 2026. Finally, the assessee must furnish a certificate from the lender to whom the interest is payable. If you're just repairing your house, or if construction drags on beyond that 5-year window, you immediately fall into the Any Other Case category under Section 22(2)(b, and your deduction is brutally restricted to just 30,000 rupees.
All right, Part 4, Certificates and Double Deductions. Let's talk about compliance rules.
Pay very close attention to Section 22(3) as it sets an absolute ironclad rule against double dipping. It mandates that when you're computing that prior period interest under Section 22(1)(c, you know those 5 installments we discussed earlier? You must first reduce that total interest by any amount that has already been allowed as a deduction under any other provision of the Income Tax Act. The fundamental principle here is simple and logical. There's absolutely no way you can claim the exact same rupee of interest as a deduction twice in your tax return.
Now, thinking back to the certificate required to unlock that 2 lakh rupee limit. If a client refinances their home loan, which honestly happens all the time in practice, to secure a better interest rate, what exactly does the assessing officer expect to see on that Section 22(4) certificate? A simple letter from the bank just isn't going to cut it.
The statute is crystal clear here. Section 22(4) demands that the certificate must specifically outline 2 critical things. First, it has to state the amount of interest payable on the originally borrowed capital. Second, if the SSC took out a new loan subsequent to the original borrowing, specifically to repay the whole or any part of that original capital, the certificate must specify the interest payable on that new loan as well. This guarantees that the tax department has a perfectly transparent paper trail linking the new refinancing loan right back to the original eligible borrowing. For instance, if your client takes a new loan at 8% from HDFC to pay off an older 10% loan from SBI, the certificate has to clearly show the interest payable on that new HDFC loan to validate the deduction.
Part 5. Aggregate Limits and Overseas Interest. Let's look at the statutory ceilings. Look at Section 22(5). This subsection is absolutely rigid. It declares that the aggregate of the amounts of deduction under subsection 2 across properties of the nature referred to in Section 21(6) shall not exceed 2 lakh rupees. What does this actually mean practically? Well, if an assessee has 2 self-occupied properties, say a primary residence in Mumbai and a holiday home in Goa, you don't get a 2 lakh limit from Mumbai and another 2 lakh limit for Goa. No way. The absolute aggregate ceiling across all specified properties combined is capped at exactly 2 lakh rupees.
And here's another absolute disallowance under Section 22(6). Suppose your client took a loan from a relative or a bank outside India to fund their property. Any interest chargeable under the Act which is payable outside India shall not be allowed as a deduction if they fail 2 major compliance checks. First, if tax has not been paid or deducted on such interest under Chapter 19(b), meaning no TDS was done. And second, if there is no authorized agent in India in respect of such interest as per Section 306. If you fail to withhold taxes on foreign interest payments, that entire Section 22 interest deduction is completely 100% forfeited.
Finally, Part 6. The Practical Master Computation, bringing it all together.
Let's quickly map out the entire flow of Section 22 with a practical scenario. Say your annual value is 10 lakh rupees. First, you deduct the flat 30% standard deduction, so that's 3 lakhs. Next, you deduct your current year's interest, let's say 1.5 lakhs, plus your 1/5 prior period installment, say 50,000. Total interest is 2 lakhs. Finally, check your limits. If it's a self-occupied property, that 2 lakh hits the exact maximum ceiling under Section 22(2). Subtracting everything, your final taxable income from house property becomes 5 lakh rupees.
As a vital final takeaway to avoid careless errors, you have to always remember the distinction between let-out properties and specified self-occupied properties. The 2 lakh and 30,000 monetary ceilings we discussed under Section 22(2) apply exclusively to properties of the nature referred to in Section 21(6), which are generally your self-occupied ones. If you have a let-out commercial property or a rented residential apartment, the interest on borrowed capital under Section 22(1)(b) and (c) is fully deductible without these specific statutory ceilings getting in the way. We have absolutely covered a tremendous amount of ground today, so when you open that complex client file tomorrow or sit for your CA finals, ask yourself, will a missed 5-year completion window or a forgotten foreign TDS deduction cost your client their entire tax relief? The devil really is in the statutory details, and you are now fully equipped to master them. Thank you so much for joining me in this explainer, and happy studying!